Have you ever taken a perfect-looking trade, only to watch the market reverse immediately against you? That's not bad luck, that's trading without top-down analysis. In this lesson, I'll show you how to apply top-down analysis the right way, using a simple, structured approach that keeps your trading focused, selective, and aligned with the market. Before we begin, here's a quick disclaimer. This content is for educational purposes only and reflects personal opinions. It is not financial advice. Trading involves risk, and you should always consult a licensed financial professional before making any investment decisions. With that being said, here's what you will learn in this video: what top-down analysis really means and how professional traders use it, how to read higher timeframes to understand market direction and intent, how to identify key levels that matter before dropping to lower timeframes, how to filter low-quality setups using higher timeframe context, how top-down analysis helps you avoid overtrading and bad decisions, how to apply a simple, dynamic top-down process with real chart examples. If you find this kind of structured trading education useful, make sure to like the video, subscribe to the channel, and hit the notification bell so you don't miss future lessons. Now let's dive in. Here we're looking at the US dollar against the Swiss franc on the 5-minute time frame. As you can see, the market is moving in a range. Price reaches this level and reverses, forming a resistance level. Later, price drops, reverses again, and forms a support level. When the market comes back to the resistance, it gets rejected once more, confirming that this resistance level is valid. Then, when price returns to the support level, it breaks below it but quickly closes back above, creating what we call a liquidity sweep. After that, the market moves higher, exactly as expected. Now, when price reaches the resistance level again, it breaks above it but then closes back below, forming another clear liquidity sweep. At this point, you might think, alright, this looks like a great opportunity to short the market. Price should go down and revisit the support level, so you place your entry, your stop loss, and your target, and you wait. But look at what happens next. The market moves against you and hits your stop loss. So why does this happen? To understand this, let's go back to the liquidity sweep setup we identified. On the 5-minute chart, everything looks perfect. But now let's step back and check the 1-hour chart to see whether this trade is aligned with the higher time frame direction. On the hourly chart, the situation becomes very clear. The market is in a strong uptrend. You can see a clear pattern of impulsive moves followed by retracements, again and again. This is classic bullish market structure. Here, when price reaches this resistance level that previously acted as support, it breaks below it and then closes back above, forming a clear liquidity sweep. This signals that the retracement has ended and that a new impulsive move to the upside is likely beginning. So on the hourly time frame, the market is clearly bullish. That means any short trade on the 5-minute chart is simply trading against the trend, and in most cases, that's a waste of time and money. Now let's go back to the 5-minute chart. At this point, even though the setup looks perfect on the lower time frame, you already know it's unlikely to work because it goes against the higher time frame trend. If you had analyzed the market on the hourly chart first, you would have focused only on buy setups like this one here and completely ignored sell trades since they go against the dominant direction. That's the power of top-down analysis. It helps you trade in the direction of the bigger players and avoid setups that only look good when you're zoomed in. Top-down analysis can also help you identify conflicting signals before you enter a trade. Let's look at this chart example. This is the US dollar Japanese yen 5-minute chart. As you can see, the market is trending downward. We can draw a trend line connecting the lower highs. Here is the first touch, and here is the second touch. When price reaches the trend line again, it gets rejected, creating what looks like a clear short opportunity. At this point, it's easy to think, the market is still trending down. Price rejected the trend line again. This should continue lower. So you enter the trade. You place your entry at the close of the rejection candle, your stop loss above the trend line, and your target at the next support level. But look at what happens next. The market moves against you and hits your stop loss. So the question becomes, do trend lines not work? Does this strategy not work? No. What was missing was a critical step in your analysis: top-down analysis. Now let's go back to the setup before entering the trade. It looks interesting on the surface, but let's switch to the 1-hour chart and see what's really happening. On the hourly time frame, the picture changes completely. The market initially started moving lower, but then we identify an important level. Price breaks below this level and then closes back above it, which creates a liquidity sweep. This signals that selling pressure has been absorbed and that the market is likely to start moving higher. And here's something very important. After this liquidity sweep, the market begins to trend upward, respecting a bullish trend line. This is the first touch, the second touch, and the third touch. Each reaction confirms that buyers are in control and that price is likely to continue higher. So now we have a key insight. On the 5-minute chart, we see a bearish trend line. On the 1-hour chart, we see a bullish trend line. Without top-down analysis, you would never see this conflict between timeframes. Now let's go back to the 5-minute chart and look at the setup again. Even though the short trade looks tempting and technically valid on the lower time frame, you now know it goes against the higher time frame direction. Because of that, you simply ignore the trade. Without top-down analysis, you wouldn't recognize this conflict. You would take the trade, get stopped out, and never truly understand why the loss happened. That's the value of top-down analysis. It exposes conflicting signals early, keeps you out of weak trades, and helps you trade with clarity instead of confusion. Top-down analysis helps you avoid overtrading. The truth is simple. Most losing traders don't need better entries. They need to trade less. By giving you clear higher time frame context, top-down analysis naturally filters out unnecessary trades and keeps you focused only on high-quality setups. Let me show you how this works with a real example. We start on the Euro-US dollar 5-minute chart. At first glance, everything looks perfect. Price is respecting an ascending trend line, and we can clearly see a resistance level forming. This creates a classic ascending triangle pattern. Eventually, price breaks above the triangle. After the breakout, the market pulls back, and a new resistance level forms. From a lower time frame perspective, the setup looks strong, so you think, let's ride this move. You enter at the close of the candle that breaks above resistance, place your stop loss below the support level to give the trade some breathing room, and you're confident the market will continue higher. But now let's pause and do what most traders don't do. Let's zoom out to the 1-hour time frame. On the hourly chart, the picture changes completely. Instead of a clean bullish environment, the market is actually trending downward. We can clearly identify a supply zone, followed by another supply zone, along with a resistance level above price. What's even more important is that price was recently rejected from this resistance and supply area. And even if price moves slightly higher, it will quickly run into another supply zone. This tells us something critical. Even if the trade moves in your favor briefly, the upside is limited, and the probability of reversal is high. There's simply not enough room to achieve a healthy reward-to-risk ratio. This is exactly the type of trade top-down analysis filters out. Now let's go back to the 5-minute chart and take the trade anyway, just to see what happens. The entry is triggered, price moves up slightly, just enough to give confidence, and then reverses. The market turns against the position and hits the stop loss. After taking that loss, you don't stop trading. Instead, you switch to another market. This time, we're on the New Zealand dollar-US dollar 5-minute chart. And almost immediately, you spot what looks like a strong supply zone. You mark the zone and wait. When price retraces back into it, the reaction looks convincing. The market gets rejected, a liquidity sweep forms, and a clear bearish candle appears. From the lower time frame perspective, everything lines up. And at that moment, one thought takes over. This is it. I'll recover the last trade with this one. You enter the position, place your stop loss and target, and this time you feel confident. You're watching the trade closely, expecting it to work. But then the same thing happens again. Price hesitates, reverses, and hits your stop loss. Now let's be very clear about something important. The problem here is not the market, it's not smart money, and it's not bad luck. The real issue is that you never checked the higher time frame. So let's rewind and analyze the same setup properly. When we switch to the 1-hour chart, the mistake becomes obvious. The market is in a clear uptrend. Structure is bullish, momentum is to the upside, and buyers are in control. By taking a sell trade on the 5-minute chart, you are trading directly against the higher time frame trend. That's why the setup failed. By using top-down analysis, you avoid overtrading and stop risking your hard-earned capital on low-quality setups. Now that we've covered why top-down analysis is so important, let's look at how to apply it in practice. Before showing you the method I personally use, it's important to talk about the approach most traders follow. I call this method the crowd technique, because it reflects how the majority of retail traders analyze the market. Although it sounds logical on the surface, this approach often creates more problems than solutions. Here's how the crowd technique typically works. Most traders begin on the weekly chart to get a broad market overview. They mark several support and resistance levels, believing this will define the long-term direction. Next, they move down to the daily chart, where they adjust those levels and start searching for potential setups. At this stage, they focus on how price behaves around the weekly zones to identify possible opportunities. Finally, they drop to a lower time frame, such as the 5-minute or 15-minute chart, to time their entry. Here, they rely on candlestick patterns or short-term signals to trigger the trade. While this process appears detailed and well-structured, it usually leads to the same outcome: information overload. As you can see here, on the weekly chart, the market is ranging. On the daily chart, the market was trending up, but has now entered a range as well. And on the 5-minute chart, the market is trending down. In this situation, no one can guarantee whether price will continue lower or suddenly reverse. That move on the lower time frame could easily turn into a liquidity sweep before the market moves higher, especially since the higher time frames, the daily and weekly, are both ranging. This kind of multi-time frame analysis creates conflicting signals. Instead of clarity, you get confusion, and that confusion leads to hesitation, bad decisions, and losses. Trading should be simple and clear. When your analysis becomes too complicated, it works against you. That's why this way of analyzing too many time frames often leads to failure, not because the market is unpredictable, but because the process itself is unclear. This is why I prefer a different approach, which I call dynamic top-down analysis. Dynamic top-down analysis is designed to remove unnecessary complexity. Instead of stacking multiple time frames, it relies on only two, making the process clearer, faster, and more effective. The idea is simple. You begin with a higher time frame to identify the most important areas in the market. This includes major support and resistance levels, supply and demand zones, and order blocks, areas where price is most likely to react. These zones define the market context and provide a clear directional framework. Once those key levels are mapped, you switch to your execution time frame. On the lower time frame, your job is no longer to analyze everything. You simply wait for setups that align with the higher time frame levels you've already identified. Anything that doesn't align is ignored, which dramatically reduces noise and bad trades. Choosing the correct timeframes follows a simple rule. If you trade on the 5-minute or 15-minute chart, use the 1-hour chart as your higher time frame. If you trade on the 1-hour chart, use the daily chart. If you trade on the 4-hour chart, use the weekly chart. By following this 2-timeframe structure, every trade is taken with higher timeframe context in mind. Your entries become more selective, your charts stay clean, and your decisions are based on structure rather than guesswork. This is what makes dynamic top-down analysis effective. Less noise, clearer bias, and better aligned trades. Let me walk you through a concrete example that shows how dynamic top-down analysis helps validate a trade setup, step by step. Using the euro against the Canadian dollar on the 5-minute chart. We begin on the 5-minute time frame, where a potential bullish order block forms. Several elements come together to support this setup. First, there is a break of structure. Price pushes above a recent high, signaling a shift in momentum toward the upside. Next, we can clearly see a fair value gap created by an imbalance between recent candles. This gap represents an area where price may return before continuing higher. Finally, the order block itself is unmitigated, meaning price has not revisited it yet. Because it's still fresh, it carries higher probability. With these conditions in place, we mark the order block and wait patiently. As expected, price pulls back into the fair value gap and revisits the order block. When price reaches this area, we see a reaction and mild rejection, which provides our entry confirmation on the lower time frame. Once the entry is identified on the 5-minute chart, we zoom out to the 1-hour time frame to evaluate the broader context. On the hourly chart, several important details stand out. There is a major resistance level overhead, aligned with a strong supply zone. However, price has recently broken above this resistance and pushed through the supply zone, suggesting that bullish pressure may still be developing. This higher time frame information gives us a clearer understanding of market intent and strengthens the setup we identified on the lower time frame. With levels now defined on both timeframes, we return to the 5-minute chart to structure the trade. We wait for price to pull back into the order block and confirm rejection before executing the entry. The stop loss is placed just below the order block, keeping it protected and logical. For the target, we aim for the next key resistance level identified on the hourly chart. Since price has already broken through this area on the higher time frame, the move we're seeing on the 5-minute chart is likely only a temporary retracement. This trade offers a 3-to-1 reward-to-risk ratio, which fits perfectly within our risk management rules. As anticipated, price respects the structure, moves higher, and reaches the target at the key resistance level. This trade works not because of a single signal, but because of the alignment between the 5-minute and 1-hour timeframes. By combining precise entries with higher timeframe context, we were able to identify key levels, understand market intention, and execute a high-probability trade with confidence. That's the real strength of dynamic top-down analysis. No matter what strategy you trade, one rule always stays the same. When you move to a higher time frame, your priority is to identify key support and resistance levels. These levels are marked on the higher time frame so that, when you drop back to the lower time frame, you can quickly determine whether your setup is aligned with them or whether price is about to collide with a strong area that could trigger a reversal. To do this properly, we rely on 4 criteria when defining key levels in market structure. Each criterion increases the strength and reliability of a level. The most important support and resistance levels are often found at the extremes of price movement. A swing high is a point where price reached a temporary top before turning lower. A swing low is where price bottomed out before pushing higher. When marking these levels, focus on the most obvious highs and lows visible on the higher time frame. These areas represent points where buyers or sellers entered aggressively, making them more likely to influence price again in the future. Extreme swing points often act as natural barriers in the market. Another strong characteristic of a key level is multiple reactions at the same price area. When price approaches a level several times and consistently fails to break through it, this shows that strong buying or selling pressure exists there. Each rejection confirms that market participants are actively defending that zone. The more times price is rejected from a level, the more meaningful it becomes. It clearly marks an area where supply or demand repeatedly steps in. Fresh levels also carry significant weight. If price has recently reacted, stalled, or reversed from a level, that area is still relevant to current market conditions. These levels reflect where buyers and sellers have recently made decisions, which often means momentum is still attached to them. Recently formed or respected levels tend to react faster and can provide precise reference points for entries or exits on lower timeframes. One of the strongest signs of a key level is role reversal. This happens when a price level first acts as resistance, rejecting upward moves, and later, after being broken, acts as support. The opposite can also occur. This behavior confirms that the level is widely recognized by the market. Both buyers and sellers respond to it, which makes it a high probability area to monitor for future reactions. When marking support and resistance, always prioritize the wicks, not the candle bodies. Place your levels where price has made the most contact, where wicks repeatedly touch or reject. This approach captures the true areas of buying and selling pressure and results in more accurate and reliable levels. Now, let's look at a real chart example to see how these concepts work together in practice. On this 5-minute chart, we have 2 strong reasons to treat this setup as a high probability opportunity. The first element is a well-defined demand zone. The presence of a large bullish candle shows aggressive buying activity, which strongly suggests institutional involvement. Because of that, this zone carries real importance and deserves our attention. The second element is a liquidity sweep. Price briefly pushes below the demand zone, triggering stop losses resting underneath it, but instead of continuing lower, the market quickly recovers and closes back above the zone. This false breakdown signals that sell-side liquidity has been collected. When these 2 elements appear together, demand plus a liquidity sweep, they form a powerful smart money combination. At this point, the lower time frame gives us a clear bullish signal. But before committing to the trade, we need confirmation from the higher time frame. When we zoom out, we can see that the market was previously moving sideways. Eventually, price breaks decisively above a key resistance level. This breakout indicates a change in market intent and suggests that larger participants are likely targeting higher prices. With this higher time frame context in place, we return to the 5-minute chart. Now we know 2 things. Smart money is positioned to push price higher. The next major resistance level is far enough away to allow room for the trade to develop. This gives the setup strong reward to risk potential. The entry is taken at the close of the pin bar that confirms the liquidity sweep. The stop loss is placed below the demand zone to protect the position. The target is set at the next resistance level identified earlier. As expected, price respects the structure, moves upward, and reaches the target. This trade works because multiple elements are aligned: smart money activity on the lower time frame, confirmation from the higher time frame, and sufficient space for price to move. When all of these factors come together, probability shifts clearly in your favor. Let's go through another real example, this time using the euro against the British pound on the 4-hour chart, which is particularly well suited for swing trading. On the 4-hour time frame, the market is moving sideways, and a well-defined support level stands out. Price has interacted with this level several times, confirming that it's an area of interest. Eventually, price pushes below this support, creating the appearance of a breakdown. However, instead of continuing lower, the market quickly recovers, closes back above the level, and then reacts strongly upward. This behavior represents a liquidity sweep. Sell-side liquidity below support is taken as stop losses from breakout sellers are triggered. Once that liquidity is collected, price reverses sharply, leaving behind a clear sign that sellers have been trapped. This is a typical footprint of market makers and often signals that upward movement is likely to follow. From a smart money perspective, this creates a valid buying opportunity. Liquidity sweeps at support frequently precede impulsive moves higher. Before executing the trade, however, we confirm the idea using the higher time frame. Since we're trading on the 4-hour chart, we switch to the weekly time frame for confirmation. On the weekly chart, the market is also ranging, and price has recently reacted strongly from a key support level. The most recent candle is clearly bullish, indicating that buyers stepped in aggressively after the rejection. This suggests that the market may continue higher, potentially moving toward the supply zone above. This higher time frame context reinforces the bullish scenario we identified on the 4-hour chart and gives us insight into the likely intentions of larger market participants. With this confirmation, we return to the 4-hour chart to finalize the trade plan. The weekly support level serves as our reference for risk, providing a logical area for the stop loss if the idea fails. For the target, we focus on the next resistance area below the supply zone. In this case, choosing the closer resistance allows for a more conservative approach. This setup offers a reward-to-risk ratio of approximately 2.5 to 1, which fits well within a disciplined risk management framework. As price unfolds, the market reaches the target level and then continues moving higher toward the supply zone identified on the weekly chart. This example clearly shows how higher time frame analysis strengthens a trade idea, improves risk placement, and increases confidence in execution. Remember, trading isn't about taking more trades, it's about taking better trades. If you enjoyed this breakdown, don't forget to like the video, subscribe to the channel, and hit the notification bell. Thanks for watching, and I'll see you next time.